Good afternoon, I'm Robyn Hall, Publishing Director of Mortgage Introducer, and welcome to our live webinar in association with Landbay. We're now currently on day 114 of lockdown. Now, the market obviously stalled somewhat in the early days of the crisis, but are we starting to see a recovery in the buy-to-let market, and will it be sustainable? To talk about this and more, and to hopefully answer some of your questions, I'm joined today by Landbay Chief Executive John Goodall and Landbay Chairman and Mortgage Funding Expert Tony Ward. Good afternoon to you both, and thank you for joining me. Now, this is a live broadcast, and we will be taking some live questions. If you do submit a question in the Q&A section that is not answered, the team at Mortgage Introducer will, along with our panelists, seek to get it answered privately, if not on the Mortgage Introducer website itself. But to start us off, I've got a question from Hitesh Taylor from Kemal Associates, who wants to know how the current lender reaction to the COVID-19 crisis compares to the financial meltdown of 2007 and 2008. Tony, what are your thoughts on this?
Well, it's actually very different. It's actually much bigger, although it's been shorter duration. And you can look at it in many different ways. So firstly, if you look at impacts on GDP, 2008 to 2009, GDP fell during that time 6.4%. This time, we're down 24.3%. GDP's 24.3% below where it was in February. So that's massive. So that's size, and it's happened very quickly. But I think we have to remember the global financial crisis was a credit, debt and liquidity issue, and that's not what this is about. And we had severe impacts directly on the banking system. It was a banking and credit market and financial market problem. And so we had things like total loss of funding through securitization and cover bonds. It took the Bank of England quite a while, I would say, to put in place measures like special liquidity schemes and funding for lending schemes. And those systems were already there. They were still in place. And so this time, the Bank of England reacted very quickly to put back in place liquidity support mechanisms for the banking sector where it needed it. Not for non-banks, by the way, but definitely for banks and building societies. It had an existing quantitative easing mechanism to pump money effectively into the economy, and it's just ramped it up massively, quickly. And I think on funding, whilst as just mentioned, we haven't had support for the non-bank sector, what we've seen is a very quick easing of the securitization market. So we've now had something like 5 deals out in the markets in the last 4 or 5 weeks. And each one has come out being fully subscribed, oversubscribed. There's investor demand for this. And pricing, whilst not quite back where it was in February, it's heading in that direction. So I would say even the non-bank sector hasn't really got a liquidity problem at the moment. So it's much bigger, though, in terms of global reach, global economies, and the long-term impacts in the economies that we need to think about.
Well, just sticking with securitization for a moment, I've got a question from Greg Cunnington from Alexander Hall, and he wants to know how the market for securitization mortgages will look in the coming weeks and months. So you were saying that stuff is starting to move, so this is positive.
Yeah, it's very positive. And I think you have to remember we're in a world where there are investors who have to invest. It's not an option for a pension fund. They have to put the money somewhere, and it has to get a positive yield, and it has to be an acceptable risk. And we're in a world of 0 to negative interest rates at the moment. So where else do you put your money? Mortgage-backed securities and cover bonds, or even investing straight in whole loans in funding new origination or buying existing loan portfolios is definitely somewhere where investors are going to look to put money. And I think, again, if you look below all the things that I'm sure we're going to talk about over the next 45 minutes, hour or so, you have to look at the long-term stability of the UK housing market. And if you're investing in something secured on UK houses, residential houses, do you really think it's going to tank in the long term? And I think investors would say it's not, and I would say that as well. So you get a positive rate of return in a world of low to negative interest rates, and there's a lot of risk in global terms. So I'm very optimistic about this sector.
Yeah, and on that, I think it's important that, post crisis, the credit quality of buy-to-let mortgages are far better than they were 2007. LTVs are lower. There's a higher affordability checks as well. So even in a house price fall, we'd expect even if house prices fell, you'll still expect sort of the buy-to-let sector to perform pretty well. And so, as Tony said, the market really closed for 3 months, and then I think the first deal got done again towards the end of June. Some of Landbay's mortgages actually got securitized and completed on last week. So that market is open, and actually the buy-to-let asset class generally has performed from an arrears point of view pretty well through the crisis.
Now, Tony, you touched on GDP before. Now, there was some pretty grim news yesterday showing that GDP rose by just 1.8%. Now, the economic consensus before that had really been expecting between 5 and 6%. Now, in the 3 months before that, GDP fell by 19.1%, and that's taken the UK economy back to levels not seen since the early 2000s. Now, as Chancellor Rishi Sunak said, the figures really underline the scale of the challenge we face. So what does this mean for the buy-to-let market? Tony, is this going to hinder what fragile recovery we've seen?
I don't think we can read too much into this. Economists, statisticians, they're all over every bit of data going. And when we've had previous webinars, and we'll have it again today, there'll be forecasts on size of buy-to-let market. Is the housing market going to collapse? What's going to happen to house prices? And it's, in some ways, it's too early to tell on this stuff. And personally, I don't think we should be reading too much into the May GDP figures at 1.8% rather than 5.5% or whatever they're expecting. I am expecting when we get to the June data things to kick up much more significantly. So that's my first thing is I would not be getting too worked up about those numbers at the moment. I think as far as the buy-to-let market is concerned, though, it's really what John just said. We need houses. Houses are baked into the UK economy in ways that isn't the same for every country in the world. It's very important that we don't have house price collapses, and I think things that the Chancellor has been announcing supports that. Supply demand is there is demand that keeps house prices up. Buy-to-let has always been, since 1996 when it started, a very good performing risk sector, despite the fact that we've had Bank of England, Financial Policy Committee and so on repeatedly in the last few years sort of pointing to it as a higher risk sector. I don't see the evidence to support that, and I don't at the moment. I think it'll do well. I'm sure we're going to talk about other changes to the buy-to-let market and types of borrowers and lenders, but that's a bit different.
Yeah, and I'll say that I think it's fair to say that the recovery for the buy-to-let, certainly from a mortgage market perspective, it really started as soon as valuers could get back to property. So really, we've certainly seen some from the beginning of June. Activity starting to pick up. Lenders across the board started reverting to 75% LTV in buy-to-let. I don't think anyone's at 80% yet, but broadly speaking, most businesses done, but below 75%. And and I know I'm not speaking to brokers, but also speaking to other lenders. Things have got increasingly busy over the last few weeks. And actually, but in terms of the real economy, and I think so, we're definitely seeing a recovery there, quite a strong recovery. Some of that obviously would be remortgage business, which probably people expected to do in Q2, so it's just been deferred, and the purchase market is picking up. But obviously, the real economy, there's still restrictions on pubs, hotels, holidays, etc., and we can't get back to where we are while pubs and restaurants and a large part of the leisure sector, which is so important to our economy, can't operate at 100%, and people are scared of going on public transport and going to the office. And I think, while, as Tony says, June and July as lockdown ease, June and July's numbers will get better, but I don't think we're going to get back to where we are fully until we have got those parts of the economy be able to operate something close to normal levels.
Of course, we've had the announcement about face masks now as well, and that might instill a little bit of confidence. And also, some of this doom and gloom, we did have Rishi's summer statement, which was only last week, seems a lot longer ago. Now, John, stamp duty was the big takeaway from that, and has been one of the main topics in the questions that have come in so far. Just got one here now from Gregory James. Hi, Gregory. In your view, does the stamp duty holiday, which ends March 2021, signal the likelihood of a permanent reform in stamp duty? Just on the same topic, Rob Jupp, Chief Executive of Brightstar Financial. He's one of the many who would have liked to know your thoughts on what the new rating will mean for the private rental sector. And yeah, what's your take on this, John?
Well, so yes, I mean, obviously, you know, it was highly expected to come in. Some people didn't think it was going to apply to the buy-to-let market. In the end, obviously, it has been extended, certainly in England, Northern Ireland, across the board. I believe in Scotland and Wales, it's slightly different. And yes, it will definitely give a boost to the sector. And I think, you know, we'd started seeing the purchase market come back in Q1. Obviously, that got stopped with COVID. And I think this gives a real sort of incentive for those who came into the year post the election with a bit of confidence to now use this window to purchase the properties they expected to. So I do think it will have an impact. But also, I think it probably gives some reassurance to the housing market generally, that actually the housing market will get supported. Property values are likely to stay either stable or certainly not fall as much as they would have done, maybe even creep up a bit. And certainly we're hearing about is the problem is not necessarily the number of potential buyers, but the number of sellers. So, you know, whether there's supply constraints. In terms of whether it is something more permanent, you know, who knows? I mean, the government needs to raise revenue, and I'm sure we'll come on to that later going forward. At the same time, they did say they were going to look at stamp duty. So, you know, those two things may or may not conflict. They may think that actually if they can get the housing market moving at lower level stamp duty, they may end up actually raising more tax revenue from it at all. So I suspect it will get looked at. This obviously was a very quick measure. It helps kind of, you know, 85% of the market or 90% of the market when you're sitting at of the market being no stamp duty. It still obviously does help larger properties, because if you're buying a property for £1 million, you're still getting a £15,000 reduction, which is still a meaningful amount. So I think it will give a big boost. And I think the other time when we changed stamp duty, when George Osborne introduced you know, the buy-to-let additional 3%, he only announced that end of November. So people only had 4 months, of which Christmas and New Year were part of that, to transact and purchase. So I think by the time you found a property, got an offer accepted, etc., you had a very short window to move. This one, we've got, what, 8.5 months or so, 9 months. So I think actually you won't necessarily see the same spike in terms of 1 month, but you'll see, you know, really transactions in Q4 and spread through Q1, where people can take their time to find properties, etc. So I think it will have a positive impact, not just on buy-to-let, but on the entire housing market.
Of course. Just sticking with the Chancellor's statement, Raj Diamond from the Right Broker, he just wants to, obviously the stamp duty was the big takeaway from the Chancellor's statement. Were there any other goodies in what Rishi said last week that we can add confidence to, Tony?
What it just seems to me, it's he's sort of giving the subtext is a bit like Mario Draghi, if you remember in the global financial crisis, that he'll do whatever it takes. Now, he hasn't said that, but it feels a bit like that, and I'm sure he wants to create that impression that he's alert to all issues or sensitive spots in the economy, and he'll do whatever it takes. And he's doing some interesting things, like the Eat Out to Help Out initiative. I mean, that's an interesting idea. Whether it really kickstarts people going back into restaurants during the month of August, it might do. The schemes to retain people, the £1,000 retention scheme, that's come into a criticism that that's not a good use of taxpayers' money, because it's probably not enough to make a big difference, and it may just end up poorly used. The trouble is, it's like, for those of you who are sort of CEOs and entrepreneurs in business, you'll appreciate that not all of your ideas will work. Even if you can get it right 80% of the time, you're doing pretty well. And I suspect he's having to do things rapidly. Not all of these things will hit the mark, but he's having to get the big picture things right. And in a sense, although this has all happened relatively recently, it was thrust upon us in sort of March suddenly. This is actually a marathon, not a sprint. the effects of this are going to be with us for a long time. But in this marathon where we have to sort of repay all this increasing indebtedness and get the economy sorted over years, the Chancellor is going to have to do things in the short term, some of which are radical, some of which won't work. But he's, you know, for my money, at least he's shown he's attentive and innovative and not afraid to do things which are a bit different. So
yeah, and I think in the broader economy, obviously they've realised in terms of jobs, it is that sort of leisure sector, pubs, restaurants, etc., that will potentially get hit harder. So, you know, that VAT cut as well is helpful if they can just maintain jobs and maintain activity in that space. And as Tony said, I think it's more the sentiment that the markets sort of think, well, actually, they're going to do what it takes to keep the economy ticking over. And I think part of the government's thinking is if they can get people to go to a pub, go to a restaurant, it's that they start to feel that it's back to normal. They're more likely to go to a shop. They're more likely to then get on a tube and go to work. And it is that sort of start process, because it's quite hard to make the argument, well, I'm scared of getting on the tube, but I'm happy to go to a pub as well. So I think it's just the whole process of getting people to move out of lockdown.
Yep.
Interesting. I've got a bit of a cheeky question from Neil Barnes from Security Financial Services. He wants to know whether the government's agenda is to remove individuals away from the buy-to-let market as an investment strategy. And if so, he reckons that they're doing a good job. And if not, do you expect the stamp duty cost to be reversed and lenders' stress tests relaxed in view of long-term interest rates remaining low and increased tenancy demand? Now, he's making the point that the pandemic will be the tipping point in many relationships, with numerous divorces and separations going through. And the ability to purchase a residential property again will be diminished due to affordability. Are we heading for divorce central? And John, what are your thoughts on this?
Yeah. So I on that first point, I don't think this government is sort of trying to move in a direction of intentionally professionalising the buy-to-let sector. I think the Cameron Osborne government was. I think this is generally, let's just try and support the property market. I don't think they're thinking through, actually, who do we want to be landlords and who don't we want to be landlords right now. I think there's, as Tony implied, the government's got far bigger things for it to worry about them, whether amateur landlords are, how they're doing. I think it's an interesting point about interest rates, because, you know, we're at a point where interest rates are expected to stay very, very low for quite a long time. And we're still applying, obviously, quite high stresses on mortgages, where I think on resi, some of it's 7%, and on buy-to-let, it's 5.5%. And you think, well, you know, when are we going to hit those levels in all the stressing? So that there is that sort of high stress threshold that I think whether the Bank of England look at, I suspect they probably won't in the current environment. But there certainly is an argument that they should probably just look at those affordabilities. In terms of demand for buy-to-let, and again, I don't know about divorces and that sort of thing, but you know, I still think that the demand for buy-to-let is going to be strong. I also think some of the residential lenders who have been lending to self-employed people have been furloughed. I think it's true that, you know, certainly in the short term, people who have been furloughed or self-employed, contract, etc., are going to find it harder to get a mortgage or require a bigger deposit or whatever. So I certainly think that will be a case, maybe not long term, but for a year or two at least.
That's interesting. So, John, what is your view on the recovery in the buy-to-let market in general? Are we going to see many bumps along the road, do you think?
Well, I think potentially, yes. I mean, obviously, we've talked about the end of the furlough scheme. You know, also coincides with the end of the payment holiday window as well. So, you know, what happens in that point in September and October, where across the board, not just in buy-to-let, where, you know, potentially you've got, you know, you can't use either of those two schemes. You've got potentially unemployment ticking up, but at the same time, no support in terms of payment holidays. So we'll see. I think that is the next point that we're all sort of waiting for as well. It won't be a linear recovery, but I think, yeah, that's probably a crunch point.
And I've got a question here from Jenny Vermeulen.
Yanni,
wants to know, what do you think the size of the buy-to-let market will be come the end of the year? Are we expecting much change from previous forecasts?
I've done this. Well, no, I've made my forecast for the year, and I sort of look through it quite regularly, looking at numbers. And I think at the beginning of the year, I think last year on UK finance numbers, the overall market was around about 41 billion, with about 11 billion of purchases. We've definitely revised our, and we thought we'd be in line with that again. Maybe the purchase number ticking up because of that. Not having an election and having certainty in the election, we thought it might be a slightly busier market, not massive recovery, but slightly busier than last year. Obviously, that's not going to be the case now, because we've obviously had a much quieter Q2, and it will be a quieter Q3 in terms of completions, as obviously application levels and activity was very low in April, May, during lockdown in particular. I think Q4 will be very busy. Some of that being a catch up. Some of that being because of the stamp duty changes. So I think we could still end up at 36, 37 billion this year overall in terms of buy to let. And then obviously next year, I think because of Q1, because of that stamp duty holiday, Q1, I think overall next year, I think will be a busy year, assuming we don't get a second spike, another lockdown, etc. So I think Q4 will be a strong one. On a quarterly basis, very strong indeed. But again, Q2, Q3 will be well below what everyone expects them to be.
Well, you mentioned stamp duty again. We've just got a question coming from John Daly, who asks, would this time be potentially a good time for portfolio investors to move properties into a limited company with the new temporary stamp duty threshold? Is that a good idea, John?
Well, I don't want to give tax advice, obviously, but if they're going to do it, it makes sense to use this stamp duty window, because they will, assuming the property is worth more than 125,000, they will make some saving on the stamp duty. That obviously that surcharge still applies as well, so that they're still going to have to pay that 3% plus obviously potentially additional stamp duty if it's worth more than $500,000, and obviously capital gains. And the one thing I'd say is obviously there's been a bit of talk about capital gains tax going up in the future as well. Now, again, it's only rumours, but the government is going to have to increase taxes. So arguably, if you are going to do it, it probably makes sense to do it before the end of March.
Okay, well, hopefully, John, that answers your question. Moving on, I've got another question here from Ramesh Debasia from Key Life Financial Services. And he's wondering whether your appetite for buy-to-let lending has changed as a result of a current crisis.
So we're not back at 80%, and someone very kindly on the chat pointed out that some lenders are at 80% in the high street lenders on the amateur landlord piece. So I stand corrected. I did think that there were many who'd returned there. So obviously some have. To my knowledge, none of the specialist lenders who serve the professional market have done. I think it'll still be a little bit of time till that happens. And again, it goes back to what I was saying. I think people will be waiting to see what happens in Q3, Q4. But we're certainly moving back. I mean, we're getting closer and closer to where we were in terms of criteria. We're not there all the way yet. We're still max loan size $1 million. I suspect that will get eased over the coming weeks as well. So, I think once we get to the end of the year, and particularly if the autumn the economy works out okay, I think we'll be at a similar place to where we were in February, March. The lending environment is still not, the funding environment is not as cheap as where it was. So all lenders are a bit more expensive than they were earlier in the year. So we'll see how that pans out on the lending environment.
And I think as well, we're going to see a continuation and maybe an acceleration of moving away from sort of single property, so-called amateur landlords, and sweeping generalization, but the larger lenders tend to focus more on those than portfolio, the specialist lenders focusing on portfolio, multiple property landlords. So that's been sort of moving over time anyway. And I think this whole situation could accelerate that. So maybe not such a growth in the market, but maybe more of a stabilization and a switch more into the specialist side of lending, I would have thought.
Yeah, and I think on that point, and again, out of full disclosure, I'm not a buy-to-let landlord, but managing a property during lockdown probably has been quite difficult. And so I think in terms of people diving into the market now and purchasing, it's unlikely to be those amateur landlords that have been trying to work from home, homeschool, as well as run one or two properties on the side where the tenants might be having problems with rent. Some properties they might have to have made more secure, the HMOs, in terms of how you can do that, and if they need to get maintenance, and how you can get plumbers, engineers around during the COVID environment. So I think it probably has been harder work for a landlord during the downturn, and I think therefore also it's less likely that amateur landlord is going to look to purchase in the current market. So we'd certainly expect the stamp duty holiday, if it leads to increased purchases, which we think it will do, we think that's going to be really only the professional landlords that are going to be purchasing in any scale.
Looking at the sort of more macro picture, where do you see the housing market going, and the general housing market going in the short to medium term? That's a question that's coming from John Mace. Tony, where do you see the market going?
Well, I think, as I said earlier, I think housing is so firmly baked into the UK economy, and has been over the last sort of 30 years or so. It's actually quite dangerous for us to see, in terms of asset values, wealth, and just psychology of individuals, to see a collapse in house prices. So, and the Chancellor understands that. So I think a lot of what you've seen him doing and supporting the housing market and our sector are to ensure that we don't see a house price collapse. It's not to say we don't see house price falls, and that will be, be varied potentially across the country, but I don't really see a collapse in house prices, I have to say.
So you could firmly rule out a crash in the property market, do you think?
Well, we've seen, again, there's been speculation every time we've done one of these. Is there going to be any house price collapse, falls? Is it going to be 5%? I've talked to loads of people who say, no, I think it could only be in the sort of 3 to 5%, others in the 10 to 13%. It's still too early to tell. And I think what's going to drive it more than anything else is going to be the unemployment figures, and those are sheltered at the moment. We won't see those to NQ3, Q4 until we can finally see. So at the moment, we've got 9 million people furloughed. There are expectations that about 1.3 million of those come out of furlough and are unemployed. But there'll be new jobs arising elsewhere in warehousing and logistics and so on. So we may move out of some sectors like conventional high street retail and into other jobs. We just don't know. It's all speculation. But rising unemployment isn't a good thing, can't be a good thing. We are likely to have that. I think it's impossible not to have it. We don't know what the duration is going to be. So end of the year, we're going to have a spike of bad news. We don't know how long that's going to last. There will be an impact on the housing market, almost certainly. But again, the Chancellor, I think, is very alert to this. And so he's not just helping the housing and the banking markets, he's trying to help the employment figures as well. He's trying to keep the economy functioning as best he can. So I don't think we'll have a crash, but I do think we'll have an adjustment.
And I think the thing it's worth pointing out that on average over the last 2 or 3 years, UK savings balances have been growing about 5 billion a month. It hasn't been linear, but on a month-to-month basis like that. But over most years, it's been about 60 billion added to those saving balances. During lockdown, it's been 35 billion a month, and those figures are up to May, so I haven't seen June's. So that means over the lockdown period, the UK population has accumulated 2 years worth of savings in the space of 4 months. And so again, now who those are and what demographics they are, whether there are people saving for their first time deposit, whether people, and obviously most of it is because they've enforced they can't spend, they can't go out, etc. So there is a possibility, and particularly this applies to buy-to-let with landlords who, have accumulated savings materially over the last 4 months, some of which might have been from payment holidays or bounce back loans or whatever, but there is savings out there. And again, while Tony said also rightly at the beginning, that's hitting funding markets and interest rate having an impact on interest rates and banks cutting their rates. But this big savings glut is still there. and it's structural. I mean, this has accelerated it. And so, you know, what you generally see when interest rates are low and levels of savings are high, you see asset prices rise typically. And, you know, houses in that sense are an asset. So while of course there may be a dip in house prices, I think it's hard to argue against a sort of medium long-term, not spike, but, you know, appreciation of house prices.
Okay, I want to move on to valuations. As ever, when we do these webinars, valuations are always a hot topic. Now, at the start of the pandemic, AVMs were all the rage, and we've had quite a few questions come in. Charles Alexander from HCF Partnership says that he's had 3 AVMs for clients, and that the average result has been a 15% down valuation when the values put these remortgage applications on these remortgage applications were realistic. Now, he wants to know why valuers are being so negative on values when there is no evidence of a major drop in house prices as yet. And John Daly again is another who reckons valuers are being too overly cautious when it's clear the property market is still buoyant, unlike the recession of 2008. Damien Grafton, he's another one from JLM Mortgage Services, wants to know if you will ever be switching to AVMs. And Paul Joslin wants to know what Landbay is doing about upgrading the AVM issue. Now, Landbay doesn't do AVMs. Tony, do you want to take us through all this AVM scenario and what's going on?
Yeah, happily. So AVMs they're not a new thing. They've been around a long while, and not just in this country. Obviously, used in the States, other major markets. And I think AVMs are fantastic risk management tools. It's just that we don't use them in Landbay to make a lending decision, and nor would I support it. I'd support it as part of a risk management tool, and that's without COVID-19, let alone where we are now. AVMs are basically statistical algorithm-driven models that take in data from a number of sources. They'll be based on real transactions that you can see for comparable properties, but they take in a number of other factors, depending on the AVM, because they're all proprietary and they'll have black box functionality that we won't necessarily be able to see exactly how it works, but it could be local demographics, local economic indicators in an area where a house is, a type of property and demand for it, and so on. So lots of existing data taken in of transactions that you can see, trying to get comparables and other economic and demographic data to provide a valuation. And what the AVM does is it outputs a valuation for a property, and it usually gives you a confidence factor and tells you basically whether the model is confident this factor is right or reasonably right. And even if you were going to rely on AVMs, you would want it to have a very high confidence factor. So to illustrate this, if it was a 3-bedroom semi-detached house in Twickenham, it might be very easy to get an AVM. If it was a detached period house in the Lake District on or near a floodplain, really difficult, I say, to get an AVM. So they don't work for every property. And typically, lenders have been using them in recent years, not just as a risk tool, but they've also used it where it's a very low loan to value, say 60% loan to value or below, lending on a standard type of property. A lender would probably take a view that actually we can rely on this. Now, we don't in Landbay, and I'm not aware that we have any plans to rely on it. We want to have real valuers look at real valuations of properties. And by the way, during lockdown, there was some innovation, which again, I've mentioned before in this, that where valuers couldn't go out and see properties, there were remote valuation tools that were accelerated through lockdown to allow a valuer to go and virtually see the property using AVM data as well as other data to come out with a valuer's valuation of a property. And I think a decent one that you could rely on as well. So that's all the things about AVMs and I suppose remote valuations, which I'd be more in favour of for Landbay. Why are valuers downvaluing? Well, last webinar we had, I actually put in, I suppose, a bit of a plea for valuers, saying I had some sympathy with them, trying to work out in a market where there were virtually no transactions 5 or 6 weeks ago, how the hell you do come up with a value when you know that you're looking at a potential economic downturn. Really tough. And by the way, AVMs, not only have we not had a lot of data through lockdown to run an AVM model, AVMs aren't necessarily very good at seeing a cliff edge that may be 6, 8, 9 weeks away. It may not be able to see it, but at least if you've got a valuer and a person, he can think about, crikey, there's things like furloughing ending, payment holidays ending. This may impact on defaults, unemployment, and therefore house prices. So it's tricky for valuers to come out with a valuation. I suppose what I've seen, I know this is true with Landbay, but I've talked to other lenders as well, is I've been a bit surprised that valuers haven't been marking down properties more. It seems to be pretty low, which is actually in line with one of these comments you just raised. There have been some bigger, more specialist properties, say in central London, that are being affected, but they're harder to value in the first place. Smaller market for them. One of the things, though, that I have seen is two things: disclaimers by valuers. So it's a question of whether the valuers really thought through the COVID-19 impacts and whether he's actually leaving you with that risk, or whether he's actually putting in some limited liability wording on his valuation that wouldn't normally be the case, that might prove to be difficult to sue on. So whilst I do have sympathy with valuers trying to do any sort of valuation, and I was expecting a down value, if we're not getting down values in, we need to look at those valuation and any caveating very carefully, I'd say, as lenders and brokers and customers.
And John, would you agree broadly with Tony's remarks there?
Yeah, I mean, also the questions are quite interesting because on one side you had a broker sort of mentioning that AVMs were down valuing 15%, and then another broker asking us, when are we going to upgrade to AVM? So yeah. There's a clear conflict there, and I agree with Tony that the physical valuations are on the whole better, and we haven't used AVMs. Obviously, probably like a lot of lenders, we investigated it, discussed it, or let's say AVMs, desktop valuations, and how we could use them with our funders and discussions, and we didn't get there, and we didn't go forward with that. Even at low LTV remortgages, it's not to saying we will never do them, and there might be certain cases where we can utilise them in the future, but I think, and we haven't seen material changes in terms of down valuation. Yes, we get some down valuations, but we got down valuations in January, February, because particularly on remortgages, typically people think their property is sometimes worth a little bit more than other people do. And so you get some down values, but we haven't seen a material difference to the level of down, either the number of properties being down valued or the level of down valuations as well. So I do agree. It's something we always looking at, our valuation process, whether we can increase it. But actually, since the lockdown was eased, we've been pretty happy with not just the valuation, the level of what the valuation report per se, and the quality of it, but also there hasn't been a delay in getting valuers out materially. Yes, it's taken in some cases it's taken a little bit longer to get access, and particularly in some areas. But on the whole, as valuers come back to market, that process hasn't been delayed by more than 1 or 2 days in terms of actually getting the valuer into the property and getting the report back. So it hasn't been as big a backlog or delay on that as I might have expected and others expected at the end of May.
Well, just sticking with valuations for a moment, Tony mentioned the COVID clause before. Jonathan Bentley from Blue Chip Financial wants to know, what impact will it have if valuers put material uncertainty on their reports and produce a pre-COVID-19 and post-COVID-19 valuation, and what impact this will have when it comes to refinancing options, whether that's on a small or large portfolio? John?
I don't, again, to my knowledge, I haven't seen ones where they're putting a pre-COVID and a post-COVID, because by definition, they put a post-COVID valuation on, a lender is going to use that one because that's the more up-to-date one, and that's how it works. So you do end up with these clauses where you get a pre-COVID and some element of disclaimers. Generally speaking, lenders are comfortable on it. They'll obviously look at the 90 days resale value as well. And again, from a buy-to-let perspective, we'll look at what the what sort of person would rent that property, et cetera, because as someone pointed out, 6 months ago, 5 months ago, you wouldn't have thought renting to a pilot airline pilot would have been a material risk, whereas all of a sudden that's probably a riskier demographic than it might have been 4 or 5 months ago. So I think we will see changes, but on a buy-to-let valuation, you're looking at those valuers' comments about the local rental market, the demand for rental properties, and obviously those comparables where you can get them, and that's the challenge, because with a low level of transactions, those comparables are likely to be less up to date.
Absolutely.
Okay.
I think under the RICS rules, there are sort of COVID-19 RICS rules for valuers. Some of them are around access. If you can't get access or is limited access, then you need to say so. So that's going to be a COVID-19 caveat in any event. Just putting a blanket COVID-19 valuation caveat, I would say, in every single case, probably wouldn't be very helpful and is likely to have an impact. So I hope valuers, I hope they're not tempted just to do that and hide behind the risk avoidance, if you know what I mean.
Okay, we've had quite a few questions come in on the different sectors of the market, specifically HMO, MUBs. Harry Sandu in the comments here, he wants to know what your general thoughts on the HMO market are, as well as Eric Morton, who also wants to know what you think on the future of those markets, whether there are any short-term implications for valuations in light of COVID-19. And Samantha Hendry from IBA Wealth Management wants to know what will the impact be on the HMO and MUB offerings, and whether you see LTVs increasing.
Yeah, so on that, I mean, we're lending to HMOs at the moment. We're and we still see them as a good asset class. We still think there's a lot of demand for them as well. So I know some lenders have pulled out of that market in the short term. It's not something that we've done. It's not something we expect to do as well. So from our perspective, and I can't talk for other funders, they are perfectly good form of collateral. We think they're a good market. There's still decent demand for them as well. The valuation around particularly the larger HMOs is a little bit harder, but again, pricing has gone up on those products as you'd expect them to generally. But for us, it's a key part of our market. Probably 20-25% of what we do is HMOs and MUFBs.
I think that question almost falls into two categories. One is, what do you think the demand for multiple occupied properties will be in a lockdown sort of social distancing perspective, and the other is risk. Just taking the first one, the social distancing, I suppose I was reflecting on, do I think we'll have another lockdown like we've had for the last 3 months if we have a second round flare up of COVID-19? And I don't know, of course, but I'm inclined to think we're more likely to have more localized lockdowns, and we're seeing that already with places like Leicester. So I think the government will be prepared to do that in smaller rather than national lockdowns. So that's the first thing. So maybe the social distancing thing won't be such an issue. The second thing is, I think at times of enhanced risk that have nothing specifically to do with mortgages, but enhanced financial risks, banks and other lenders tend to pull in the horns, and areas that would have been deemed to be a higher risk or a slightly higher risk when they're trying to moderate their use of capital funding, distracted on other things like working remotely and all of this. It's very easy to pick off areas like HMOs and say, well, that's not an area, we're going to pull out of that for the moment because our risk appetite is diminished at the moment right across the board. But that's an opportunity, isn't it, for those who understand the risks and want to stay in it.
Okay. An interesting question coming on holiday lets. Now, it's obviously been in the press quite a lot, the growth in staycations. Is the holiday let market something that's going to be attractive to Landbay?
It's not something we operate in. It's not something we've really looked at, to be honest. I know there's a number of lenders that have entered that market over the last year or two. I think also there's always that risk on holiday lets that you're, from a regulatory risk, whether it's a residential in disguise. We're not a regulated lender, so we don't own those missions. So potentially that's why we don't operate in that, or we're a bit more nervous about it than others that do operate in that regulated space. So it's not something on, it's definitely, we're not saying never at all, but it's not something on the cards at the moment. We think the sort of buy-to-let market is such a big opportunity at the moment, as I say. So we've got no plans on doing it, but I say we're not going to rule it out forever, if that makes sense.
Well, sorry, that was a question from Ross Williams. So thank you, Ross. Got a question here from Gavin Scott from Money Doctor Financial Planning, who wants to know whether you can see an increase in appetite from lenders to cater for the increasing demand from older borrowers, say those in the 60 to 65 age bracket, and also the so-called professional landlords, those with 5 or more properties. More appetite in that sector, John, perhaps?
Well, yeah, I mean, the way we do it, we look older borrowers, we look at the age at the end of the term. So if someone's 65, 70, we won't be able to probably give them a 30-year term, but we're happy for things to be 85 at the end of term. So it may well be that term is short. Obviously, in most cases, people do refinance after a fixed rate period. So in that sense, we serve that market. And obviously, professional landlords, we've talked about that before. Yes, they're the ones I suspect will be taking advantage of stamp duty holiday for the buy-to-let market, and certainly we've seen that trend over the last 3 or 4 years. Anyway, with the sort of average size of the portfolios getting larger amongst landlords as those amateur landlords are either dropping out or not adding to their portfolios.
I also wonder how many people in the 60 to 65 year age bracket who were working, who've now been at home for the last 3 months, decide this is an opportunity to segue into semi-retirement and pursue other activities, including investing and managing buy-to-let portfolios. Don't know.
Well, here's hoping so. Now, we are in the middle of summer, and I'm sure we could all do with a holiday, whether that's a staycation or going abroad. But we do have a lot of people that want to talk about mortgage holidays. Kip Peterson from Wise Mortgages wants to know a little bit more about mortgage holidays, and specifically whether lenders can fairly inform customers that taking a mortgage holiday could affect their chance of switching lender or taking additional borrowing in the future. Colin Jackson on payment breaks, what's the experience been in terms of the appetite for borrowers to extend payment holidays beyond initial 3 months? And Steve Olenjanik asked, how are you treating borrowers who have taken government loans, such as the CBILS, BBLs, when looking at future applications? Where to start with that one? Go back to you, John.
Yeah, I mean, it's certainly in terms of, in response to Steve's questions, we look at every case, on its merits. So we haven't got if you've taken a bounce back loan, then we won't lend to you. If you've taken a payment holiday, we won't lend to you. So there's not this blanket ban on that sort of thing. We look at understand the reasons why they took it, etc., and whether we think there's sort of underlying, financial stress. And whether there's likely to be in the future. So, we look at the whole picture and think, well, actually, does that loan make sense? Are we comfortable that they'll be able to, effectively repay make their interest payments, et cetera, over the period of the loan? So that's what I'd say there. In terms of sort of payment holidays and extending them, yes, some have extended beyond 3 months. A number haven't actually. Our numbers have definitely fallen. A number have decided not to extend. I think they realise that if they've got ongoing payment holidays and they want to purchase properties, then actually it's going to be a lot harder to do it if you've got those payment holidays outstanding as well. So, and that's something we did when borrowers asked. We notified them and said, look, this just be clear about what you're asking for here. That it may well be that and this applies particularly to buy-to-let, because none of our borrowers have multiple properties. If you're a home loaner, then a homeowner, you're less likely to be buying in the short term. So we've made that point as well. We notified borrowers when they applied for them, and some of them decided not to take them on that point. And ours, we've been fairly flexible with those that have taken them, whether they want to add that to the loan. But understanding what that means for LTVs, and we've talked about that before, potentially where actually if you're increasing LTVs and a property price is falling slightly and you're already at a 75% level, getting an 80% is harder. So it might not be the best thing to do if you can afford to pay it off and either as a one-off or actually pay it off over the first 12 months and increase payments that way. So we've tried to be flexible, try to sort of do right by the borrower, but also make prudent lending decisions.
Okay. Just moving on to the future of the market, there's an interesting question here again from Rob Jupp from Brightstar Financial. Now, he's looking at the future growth of the market. Now, will we see new market entrants in the UK buy-to-let market over the next 12 months? Or will investors be more likely to acquire existing incumbents?
Ah.
Well, I guess that's one way of saying, is Landbay up for sale?
Yeah. So I'll have a go first, and John can answer the question you just raised. It's a good question, but when you think about it, we're in a mortgage market that's completely oversupplied by existing providers. So in a sense, why do we want even more buy-to-let lenders coming into the market when it's got more than enough? So I suppose that's one way of answering it. But do you know what? I fully expect us to see more buy-to-let lenders coming into the market. You just can't stop people coming in, being entrepreneurs, and there'll be twists on this as well. I'm sure we'll see people who either spot opportunities with products or use of technology to give them an edge. But you really do need an edge somewhere, because in a very crowded supply, it's not for the faint-hearted. If you're a startup, you've got no economies of scale, nothing special in terms of funding or technology, and your products are the same as anyone else's, probably better to go and buy someone like Landbay. But if you've truly got something a bit unique, which is hard to find but not impossible, we're going to see some new players, I'm sure.
I think on that, I mean, obviously, looking at an article I read about PRA, there's still a lot of new banks in the pipeline to get licenses, or people to get banking licenses. Either they've just got them or they're getting them over time, and they're in that process. And obviously, some of those you expect would become buy-to-let mortgages as part of their mix. So I suspect, as Tony says, they will do. But I think it's harder to enter now than it was when we did. As Tony said, it's a more competitive market. The market is well served. So what's a new lender bringing? Is it just similar sort of products that's already out there in the market? And again, just from a human point of view, it's an intermediary market. Broker, sales teams, BDMs, they go out, they meet brokers, etc., etc. They go to expos, they go to fairs. That's one of the key ways to sort of get to market. That's very hard in an environment where you're socially distancing, and it's very hard to visit other people's offices. So to build that sort of presence in the intermediary market, I think is much harder than it has been in the past. So, and I think also, from a funding perspective, if they're not banks, this sort of crisis, we and other lenders, I'm not singling out, we've got a track record of going through this crisis, and I think funding partners like that, because they can say, okay, you weathered the storm. Let's look at your arrears during that crisis. Let's look at the performance on the holiday, the mortgage holidays, etc., etc. So if I think for a new lender to come to market where they don't have that data, they don't have that track record, again, it's just harder to attract. It's not impossible by any means, but it just becomes harder to attract funding on that basis as well.
Well, I suppose if the potential new lender can find the right niche, then there is an opportunity, and you would welcome the competition, I guess.
Absolutely,
we always welcome competition.
Now, we have been talking about buy-to-let, its recovery, and whether it's sustainable. Samuel Daly from Spencer James Financial has taken this one step further, though. In a changing landscape, it's a minefield for many prospective first-time landlords, with location maintenance, tax growth, tenant issues, risk of malicious damage. Now, he's saying if you compare that with the possibilities of alternative investment options, such as cryptocurrency, easy-to-use stock market trading apps, this is a real appeal for buy-to-let as an investment. Is the appeal still there for millennials and Generation Z and Centennials? Basically, he wants to know, is the buy-to-let market sexy enough for true long-term sustainability?
Banking isn't supposed to be sexy. It's supposed to be dull, dreary, and dependable. That's the sort of virtues in banking of financial markets. That doesn't stop innovation, but sexy to me in this context sort of suggests volatility. So yeah, there may be some really exciting new markets and investments you can go into, but investing in something that's bricks and mortar, that, as we've discussed in the last hour, is being seen by the government as something that has to be supported in a stress scenario, is giving a positive rate of return versus 0 to negative in interest rates, and God knows what's happening to stock markets. I know where I put my money. I'd invest in property. It would always be part of my investment portfolio.
And I think on that, I mean, I think as a point, we've seen sort of increased regulation, coming in to the space, not just obviously from a lending point of view, but also how landlords manage their properties, et cetera, et cetera. I expect there's going to be more of that as well. So, and that's part of the whole theme we're talking about, professionalisation. It is less appealing to an amateur than it was, from a financial point of view, but also it is more complicated than it was as well. So, on that side, I think if that's the question, is it an exciting investment for an amateur? Well, no, but it shouldn't be. As Tony rightly says, it is a business, really. You got to think about it, and you should approach it in that way. And if people want to do something that's fun and sexy, then go and buy some Bitcoin.
Fantastic. Well, that's brilliant. Thank you both. Well, that does bring us to the end of this special Mortgage Introducer webinar in association with Landbay. Thank you to both John and Tony, and thank you at home for watching. You can watch this broadcast again via various social media and also on the Mortgage Introducer website, which can be found at www.mortgageintroducer.com. I'm Robyn Hall, Publishing Director of Mortgage Introducer. Thank you, keep well, stay alert, and stay safe.